Welcome to this week's Lifetime Real Estate Advisors podcast. It is February 9th, 2024, and we are your hosts. We got Brady Mullen, and I am Dan Mullen, the CPA mortgage guy. And today we are going to talk about our spreadsheet that we built that helps you understand what kind of returns you can make on a given investment property. It's a tool to help you analyze the numbers. So, when you're analyzing investment property, one of the things you want to do is save money on gas. You don't have to look at every single property before you run the numbers. One of the beautiful things about investing is you run the numbers before you decide, here, I want to go out and see this property. The point of this is that the numbers don't tell you everything, right? They're going to be helpful. We want to know them. It's going to be very crucial to know what they are and have good projections. But at the end of the day, you also want to go out to the property. And if you see it and there's the floor is rotting through or something like that, or some cracks in the foundation that aren't shown in the pictures, that's going to be really important to you in making your decision. So anyway, we're going to talk about this investment pro forma sheet. We hope it's helpful. If you want a copy of this, we'd like to have a conversation and kind of help you guide you through it. You can email us. My email is thecpamortgageguy@gmail.com. And Brady's email, I believe, is brady@ltrea.com. So, hi, Brady. You want to talk about this sheet and how it came to light? I think you were the originator of the idea, and we both made revisions to it as it's gone along.
I just remember buying some real estate and not knowing what my rates of return were. And I wanted to know that, but it's not so simple as in stocks. It's easy because what did I pay for it? What's it worth now? And then with the calculation of how long it took to get there, you can calculate an annualized rate of return. And in real estate, people don't talk about annualized rate of returns very often. In many cases, they talk about cap rate or cash on cash, and those aren't unuseful metrics, but they're not an annualized rate of return. The cap rate is just a measurement of the income that it creates as a percentage of the value. So anyway, I wanted to know annualized rate of return so that I could compare it to things like stocks and mutual funds and stuff like that. And I just noticed that there's a lot to it, and I don't see a lot of people making those connections to do a overall annualized rate of return on the investment. So that's what kind of got me into real estate to begin with. As far as my career, I sold my practice in finance because I wanted to tell this story, and I couldn't talk about this freely while I was a licensed financial advisor because they can't advise on real estate investments. They can't help underwrite real estate investments. The compliance industry in that, or the compliance department in that industry, has a big problem with that. So this is what the original, where the snowball started, that has become something bigger because this was the thing that got me going on it.
Yeah, and I like the sheet in particular because it's great for beginners and advanced investors alike. It's great for beginners because it has that annualized rate of return. For example, if something has a cap rate of 7%, that's pretty good by a lot of metrics, depending on the area and such. But if somebody looks at cap rate 7% and they say, well, I'm getting 8 or 9 or 10% with my financial advisor, why would I invest in real estate when it's an apples to oranges comparison, right? And so it's one of the reasons I love this sheet, and I was happy to work on it with you. So you want to
Yeah,
dive
that's
into the sheet, or
common.
do you got any more? Yeah,
Well,
that's common.
I was just gonna to add to what you said. A lot of times people think a cap rate is a rate of return, and it's just not. It's but I think it's often confused because it's expressed as a percentage, and it's expressed in a range of somewhere in a range where people are kind of expecting to earn a return on their money. But cap rate is not a rate of return. It's only one small portion of it. It's only measuring cash flow. But of course, there's appreciation and tax savings and debt pay down and things like that add to the bottom line. So I'll just share this real quick. We'll just start with this. So this
I
is
want to I want to emphasize, as we're going through this too, it's important to note that there are four sources of growth on an investment property. And by investment property, we don't mean fix and flips. That's an entirely different game with there's some overlapping skill set like fixing a house and, that kind of stuff. But we're talking about long-term rentals and short-term rentals here. And we want to talk about the four sources of those growth. First, we have the cash flow, obviously, and that is important, much more so important toward the end of your investing career or retirement. We have the cash flow, we have the appreciation, we have the tax benefits, we have the debt service pay down that we're paying when we pay the mortgage every month. So that's important to know. That's how we get to annualized rate of return. It's not just about cash flow. It's not just about appreciation. It's about the whole picture.
perfect. So the way this is set up, I'll just show you a big picture and then we'll zoom in. This is the dark cells here are the variables that we can manipulate. Then everything else is just a product of that. There's a lot of sheets behind that are hidden that where all the stuff is happening and being calculated. And I bring it forward in what I call a dashboard. So this is the dashboard where we can see the high level things we need to see, but there's a lot of stuff going on in the background, and these darker cells are the variables. So let's zoom in and talk about them one by one real quick, and then we'll talk about the picture they create. So there's the sale price. So that's the purchase price. This is the percentage down. This is if there's any improvement costs to be made. That's what would go into here. So if it needed $25,000 worth of renovations, we'd put that in here. This would be something like sweat equity. So if I put $25,000 of renovations in here and that gave me $45,000 of equity, then I would put that in here to capture that increase there. This is the closing costs on the loan. Some loans have points that need to be paid in order to get them. This one, I don't have that factored in, but that we could obviously add that. And then all these things in this cell determine, okay, this is what I need to bring to the table. It's about $120,000 in this case to buy this property. Now we go into the property specifics, like the income and expenses. Rents for $2,750. I'm always going to project something less than 100% occupancy. So I'm showing 96. This comes, when we look long into the future, we're going to assume that there are some months occasionally where it's empty. So that's what this is for. This variable, I'll toggle this later, but this is, what do you want to do with the extra cash? Are we putting that in our pocket, or are we paying down the loan? So there's an option where we can pay down the loan with that. This is the loan rate. This is if there's a buy down. That's not really common on an investment property, but it's not unheard of. There's a loan term. A buy down would be like a 2-1 buy down or a 3-2-1 buy down for people that are, they want to know what I mean by that if they don't know. This is
That's hard to pull off on most investment properties because if you're doing something like a conventional loan, those are limited. DSCR and other types of non-QM loans will open that up a little bit. So yeah, that is a possibility, but uncommon.
Yeah. So there's the annual tax, annual insurance, the HOA, utilities. This is only utilities that are being paid by the investor. So these are zero here because the utilities are being paid for by the tenant. This is a maintenance budget. It's expressed as a percentage of the value of the home. And in each of these cells, I have some notes off to the side that kind of explain, here's what this is for, here's some ranges to be considering. And then this is any additional monthly cost that isn't captured by anything else here. I think of it as a catch-all, and how long those monthly costs are going to be baked into the expenses. So let's say
if
that
you do something like get a HELOC, right, in order to fund the down payment. You get a HELOC on your primary home or maybe one of your investment properties. There are fewer and fewer banks doing those on investment properties, but they are available some places. But yeah, if you have a HELOC, how much does that give you? How much cost is that costing you every month? And how many months are you doing that for?
Yeah. And then this is whether it's being managed professionally or not. Now, I realize that this is more complicated than just a yes or no question, but the variables that determine how that management expense is being baked into the pro forma are on a different page, an advanced variables page. So if this is no, then we don't include management costs. If it's yes, then the management cost would be determined here. I'll show you what that looks like really quickly. There's just a few variables on here, but that's where we would determine how the management costs are being expressed. So let's go back here. Okay, so now this shows the net monthly income. This is what I'm showing it going into reserves for maintenance right here, this 190. And then these are the assumptions that I'm using. I'm using 4.5% depreciation, 3.5% inflation, 4% rent increase, and the marginal tax rate for the investor at 24%. These are all variables. So if somebody's watching this and thinking, well, I want to see what it would look like if it only appreciated at 3%, awesome, put 3% in there and watch the calculations absorb that and calculate that. So these are all things we can change. This comparison rate, I'll express that, or I'll explain that in a second.
Yeah, because we want to know where you get it. Like, how do you know where to get all these variables? How do you know how much you can rent for? How do you know what the property taxes are? How do you know the sale price? Those kinds of things.
Yeah, you work with a good agent that knows that area and can look up what you can expect to rent it for, what you can expect to pay for it, what the taxes are, right? We can do a lot of underwriting very quickly in just a few minutes by looking at the MLS and then looking up what it will rent for. But you want an agent that knows the area so that we're not just blowing smoke, right? It needs to be data that is reasonable.
Yeah,
So
Zestimates, for example, and Zillow data is kind of notoriously inaccurate, right? And so if you're looking at, yeah, Zillow says this will rent for X amount, like, well, maybe that's a ballpark, but let's do some more math on it. Let's do a little more investigation of that. And a great agent can help you do that.
yeah, and in many cases, like Zillow is a great convenience, but it's just the tip of the iceberg. I would never buy something or make a decision based on what I see on Zillow. It's just a
Right.
place to get a lot of information quickly without having to call anybody. But it's not trustworthy for deploying hundreds of thousands of dollars.
Sure.
So now this graph is the total investment value. This is the one that I'm most interested in because it shows me the value of my investment. So I invested $119,000. This is the value of that investment over time. So the dark blue is the equity portion because your investment is made up of two elements. There's the cash that is put in your pocket and the equity. And the equity is this dark blue, and the cash that you've accumulated over that time is the white here. So by year 10, I've put $171,000 and some change in my pocket, and I have $414,000 of equity for a total combined value of my investment of $586,000. And now I have all the elements that I need to calculate an annualized rate of return. I have how much I started with, I have how long it took me, and what is the value that this investment has created for me. It's $586,000. This yellow line here, this is relative to that, or this is being created by that. I called it the comparison rate at the bottom. Remember, I said I would explain this variable in a minute. This is set at 10%, and what this is showing is had I invested the same $119,750 into some investment, some hypothetical investment that was earning 10%, I want to track that on top of this option that I'm looking at, which is the real estate. So this is what that financial value would be of if that investment were making 10%.
Yeah.
Okay. Now let's
Can I make
look.
a note here?
Sure.
So again, we mentioned toward the beginning of the podcast that there's four sources of income on there. Those can further be broken down into two
Four
sources. So you go
social
back up to
sources
the top
of
there.
four sources of not income, four sources of investment
Excuse
value,
me.
wealth
Right.
creation. Yeah,
Wealth creation. Okay. So can you go back to the top graph?
sure.
So the four sources, like I said, I mentioned there's cash flow, there's appreciation, there's debt service, and there are tax benefits. So those are broken down to two. The debt service and the appreciation is the dark blue bar there. That's your equity.
Yep.
And the cash flow and the tax benefits, those are in the same category. So that's your white bar there. So
Yep.
those are all captured.
Yep. Perfect. Okay, there's the net monthly income. This is just a really important graphic because you want to know how much you're cash flowing on a given month. So this graph just shows what's your net operating income in a given month? Like what are you clearing in a month? Now I like this because this is an investment where somebody put about $120,000 in. It's only cash flowing at $36 a month, which can seem kind of depressing. You deploy 120 grand and you're cash flowing basically nothing, right? 36 a month is not worth, you're not going to get wealthy on $36 a month. But remember, A, that's increasing over time, and B, that's only one of the four ways in which you're creating wealth in real estate, but it's still an important number to know, right? Because if I'm going to be negative cash flowing $1,000 a month, I want to know that before making a decision. That doesn't always mean it's a bad decision, by the way, but you have to be prepared for what that's going to mean. So this is an important metric. It just isn't all of the income or all of the wealth creation.
Do we want to talk about negative cash flow and why that will deter a ton of investors. Like, hey, there's a property running all these numbers, it's a negative cash flow. Why would anybody ever do that? I mean, like we talk about in some of our classes and other materials we teach, cash flow is what the masses are after. And then I think they're missing the forest for the trees because negative cash flow, I mean, I contribute to my 401k every month a few $100, and that's considered negative cash flow. But I know what it's doing on the back end. I don't suggest only investing in real estate. You want a truly diversified portfolio. You know, you have real estate and you have paper assets as well. But negative cash flow, so many people hyper focus on it. When you look at, especially the beginning years, most of your wealth growth is in that appreciation and in even a little bit of the debt service. So that's important to know. And you want cash flow, of course, near the end of your investing career, right? But it's not everything up front. And if you use more leverage up front while you're building your real estate portfolio, it will pay off because once you have a bunch of properties, you can leverage those in ways that increase your net cash flow. You can either sell a couple of them and pay off the mortgages on the others, or you can refinance, or there's a lot more you can do with more property and more equity.
Yeah, I couldn't agree more. I am careful about negative cash flow because it's not like positive cash flow is better than negative cash flow,
Of
clearly.
course.
But if I'm in a phase of my life where I don't need the income, I just want to be smart with my money, then cash flow just isn't the only component to focus on. I'll get back to that in a second when we look at these rates of return. So let's look over here to the right. There's just snapshots at year 1, 5, 10. So by year 1, I'm only cash flowing $36, right? We saw that in the graph below. But at the end of the year, I've got $137,000 of equity, and I've accumulated $8,455 of cash throughout the year. Now that comes from the tax benefits and the little bit of cash flow. Those are being clumped together to show what cash benefit have I received by investing in real estate. So the combination of these two make up your total investment value. That's a 22% rate of return in the first year. That's not bad. Now watch, well, I'll go back to this in a second. By year 5, my cash flow is looking a little better. I've put 60 grand in my pocket in tax savings and cash flow. I've got $245,000 of equity for a total investment value of 304. I'm at 21% or 20.5. And this just shows snapshots by year 5, 10, 20. The reason this is declining each and every year, these are annualized numbers. So every time we de-lever, our return on equity each year is getting a little bit smaller than it was the year before. So these are annualized figures. A way that you can address that is by taking that stale equity and reinvesting it if you still have time and want to acquire more real estate. And we can talk about that maybe on another show. But these are your annualized rates of return here on the right at different points in time.
And I wanted to mention too that the reason you'll see that decline, for example, between years 10 and 20, the annualized rate of return there, it's 17.2 and 13.7. The reason that accelerates toward the end of as it gets as you have that investment longer, the loan matures, and so a larger portion of those mortgage payments is principal, and so that ratchets up your equity quickly, but your return on that equity, because it's larger and larger every year, it's growing, but the percentage is shrinking because of that. So, like you said, using that debt equity to reinvest is a great idea to keep those first year metrics high on your annualized returns.
Yeah, and what's going to happen over time is it's not going to go to zero. It's going to go closer and closer to what that investment would do for you had you not used any leverage, right? It's going to get closer and closer to the rate of return that you would experience had you purchased the property cash. That's where it will level out and shoot out into infinity.
Can we do that? Can we purchase this property with cash? Let's say we have 100% down payment. That's how we can show this. This is why leverage is so huge in investing in real estate, especially in your early stages of doing so. You want to put your down
let's
payment
put this down. Let's put the down payment to 100%. So you're not using so you're not using any loan. Now, of course, we won't have this loan cost here. So we won't have to do anything there. So there's your rate of return, like 11.71, 10.86, 10.10, 9.10. So yeah, it significantly reduces your annualized rate of return. But it does give you better cash flow right out of the gate because there's no mortgage to service, but it took you $455,000 to buy that property. Right. So you had to deploy a lot more money. Another thing worth looking at, let's just look at let's go back, let's put a cost for the loan and put this back up to 25. I want to show a comparison. I find this interesting. There's a good reason why they call loans in real estate investing leverage. Right. Let's go further out. Let's look at maybe the 20-year annualized return or even 10. So that's at 17.21 if we leverage it at 25%, which is where we started. So these are the same variables that we started with. If we change this, let's say we change this to 20. Now, what most people would focus on if you did that is they would look at this and say, well, I would never do that because it's negatively cash flowing. And $129 a month of negative cash flow, if you can't really handle that, you probably shouldn't be investing in real estate anyways. But that's neither here nor there. But people, people would look at this and be like, why would I ever buy anything with negative cash flow? Well, you're using a bunch of bank money to do it, which isn't the worst thing in the world. But look what it did to my rate of return in 10 years. Remember, it was 17.21. Now it's 18.86. Like leverage moves the needle a lot.
I wanted to say something on leverage too. Sometimes people want to say, I want to put as little down as possible and get a loan with 10%, 15%. And there's a little caution there too, because if the reason for doing that, I mean, there's two reasons to do that. Number one, that's all you can afford. And if that's all you can afford and you don't have reserves, if something goes south on this property, that's kind of dangerous. I might
Sure.
suggest maybe building up some reserves before you do that. Number two, your terms are much worse. So usually if you have like a 10 or a 15% down program, you might have mortgage insurance. But at any rate, I've done the math on this many times. Your rates and your upfront points skyrocket until you get to about 20-25%. 25% is really the sweet spot. You're doing something like a DSCR loan or a conventional investment property loan, but it's going to get real expensive the less you put down, because interest rates are based on risk. And the less skin in the game that the borrower has, the riskier that client is. And so the bank knows that, so they're going to increase their interest rate. So a couple good reasons to put at least 20-25% down on these properties.
Yeah, well said. So, yeah, that's kind of how that works. It's not, sometimes people want to use this to try to look backward and see what rate of return they got on past investments, which can be helpful, but that's a little difficult because you have to infuse expenses and cash flow in the day that they happen. This is better for projecting the future and underwriting a current property to see what you may get. And look at this. This is a cap rate of 5.75%. And again, if you don't know what that means, that doesn't look like a very sexy idea. But if we're looking at this and thinking, gosh, over a 10-year period, I'm expecting 18.86% rate of return. How does that anything close to the cap rate? Well, it's because cap rate isn't a measurement of rate of return. It's a measurement of what percentage of my net operating expenses, or rather my net operating expenses are what percentage of the total purchase price of the property. So it's not a rate of return metric.
One thing I wanted to bring up too is, and you guys have gone on for some time here, and you haven't mentioned a very popular metric that a lot of real estate investors use, and that is your cash on cash. Where is that? How much do we care about cash on cash? Is it important? How do we use it? How should we use it?
So this one would have a negative cash on cash rate of return because it's negatively cash flowing. If we wanted a positive cash on cash rate of return, we'd have to put enough down so that this is positively cash flowing. But even still, this is not a great positive cash on cash. This is $36 a month, which is going to be about $4,200 or $420 a year on a
Yeah.
$120,000 investment. That's not a great cash on cash return. I believe that's on this page here. Yeah, my cash on cash here. Oh, because cash on cash is also going to account for the amount that I'm setting aside for maintenance and repairs. So based on a cash on cash comparison, this is still negative. So a lot of people would look at that and be like, boy, I would never invest in that. And I'm thinking, well, why wouldn't you want a 20 or a 17% rate of return over 10 years? That isn't bad. And I'm only assuming 4.5% appreciation, which is, I think, conservative in a metropolitan area. So cash on cash is another one of those things like cap rate that's poorly understood and blown out of proportion. It's not unhelpful to know what it is. It just isn't nearly everything.
Yeah, that's a good point. And it's interesting to see too just how real estate investors talk about these things together. And when you want to know what those are, and you want to have some way to calculate those when you're in those circles, because sometimes they'll talk about it in those ways. So they are useful in that sense too. But there's also a lot of some rules that have kind of changed, like the 1% rule has been a really popular. If it's not getting 1% per month, don't invest. That's kind of an ironclad rule you hear on a lot of popular shows, and it's in the zeitgeist in real estate investing quite a bit. But today, with the market is where it is. That's pretty rare find. And what I find interesting too is people say who have invested or want to invest, and are foregoing doing so in today's environment because they're not going to get, it's not the same environment as it was in 2020 or 2019 when, some of these projections look so much juicier. One of the points we make too is we don't know when the best times to invest in real estate or in anything are really. We don't know when those times are until we have some clear hindsight, until maybe several years later. And it may be now, it may not be now, we don't know. But at the same time, it's the rules have kind of changed as far as where our metrics are and what we can expect to be a quote good investment, because just market conditions have changed and they're always going to change.
Yeah.
So, all right. Any other thoughts to add before we wrap this up?
Well, I could talk about it for hours, but let's not do that today.
Yeah, we love talking about it. But thanks for joining us today. We hope you have a great rest of your week and weekend and all that kind of stuff. If you're listening to this far in the future, we hope the rest of your day is as pleasant as you are. So have a good one, and we'll talk to you next time.
Thanks, Dan.